most of the time, rather than losing from the market correction, they lose money because of the improper activity of the portfolio rebalancing. When you have a smooth road to travel some to reach some destination, why should I choose the harder road? So even if you are keeping your money at your locker safely, your money value is eroding by day because of the inflation.
All right, money conversations that help your savings grow smarter. And indeed, we celebrate the minds who work behind our money, the independent financial advisors, celebrating them and their feats, their achievements, and also taking some invaluable advice from them. Today, our IFA for the day is Ezhil Murugan, a certified financial planner, experienced investment advisor based in Chennai. He's the founder and director of Wealth Seva, a firm focused on financial planning and mutual fund distribution. They've been operating since April of 2019. Ezhil actively shares his financial expertise through videos, interviews that aim to educate the public on smart investing, mutual funds, and personal finance management. His work is particularly valued in the community for making investment concepts accessible and practical. Ezhil, wonderful to talk to you. How are you today?
Hi, good Rishi. How are you?
Excellent. The theme we're
Yeah.
going to be talking on is the best way to tackle market volatility leading to asset allocation as a critical aspect of investing prudently. Yeah? So let me start with people who lose money because markets fall. Do people actually lose money because markets fall? Or because they change allocation at the wrong time? Let's put our finger on it.
Yeah, very good question. One of the famous fund manager once mentioned, my investment return is positive, but my investor return is negative. So investor primarily lose money not because of the market, most of the emotional call what they are taking. So due to some panicness in the market and wrong time reallocate the portfolio. Most of the time, rather than losing from the market correction, they lose money because of the improper activity of the portfolio rebalancing. That's a major cause. So the behavioral gap, that's what we are saying. When the market always has a different opinion, it will go ups and down on the regular basis based on the regular the crowd opinion. But investor has to stay in the market for as per the goal, not for the numbers. So that will give the proper return to the investor over the time, not on the immediate market ups and downs.
If two investors earn the same return but one experienced less volatility, who in
Yeah,
your books invested better?
obviously, see, if you are getting the same kind of the return, why should I take a risk? Volatility is a kind of the risk only. When you have a smooth road to travel some to reach some destination, why should I choose the harder road? So volatility means if you are getting the higher return, then it's worth. There's something called the Sharpe ratio that will give the number that the risk what you are taking, what kind of the return you are getting higher. But if Sharpe ratio is less, there is no point of taking volatile investment. So better be a safe investment with a minimum volatile. If you are getting the better return, that's a nice call rather than going for the volatile the investment avenues.
Yael, as you've noticed, is quite the expert as far as independent financial advice is concerned. Beyond his professional role, Ezhil Murugan is recognized for his commitment to helping individuals achieve their financial goals through well-informed planning. He's also known as a corporate trainer for NISM courses and has helped many people to successfully clear the NISM exam. His expertise extends to educating and guiding others in the financial domain, especially in mutual funds and related certifications. And we're speaking about the best way to tackle market volatility leading to asset allocation as a critical aspect of investing prudently. If you had to design a portfolio yield that an investor is not going to touch for 10 years, how will that look?
So 10 years is a very good time when you are planning for the investment as a goal oriented. Or 10 years is a very decent time, but without looking at the portfolio, it's not a good idea because any investment advisor advise that once in a 3 to 6 months you should review the portfolio. It doesn't mean that every day you are looking the portfolio, changing something or shuffling something, not a good idea. As well as it is you are living the portfolio for 10 years is also not a good idea. But 10 years idea as a goal oriented. If you want to build a portfolio, have a proper exposure of all different asset classes, which mix of equity, gold, silver, and the international. Because the last 1 year is a very good example for, or the equity is not performing good, and the gold and silver is unexpectedly is done well, and the other way the international market is done better than our emerging Indian market. So being asset allocation, build a proper portfolio with a 70 in equity, some 15% in silver and gold, and some 5% into international funds, and 10% for the debt side, so which may be useful for your emergency requirements and all.
Ariel, are investors more comfortable with guaranteed low returns than uncertain higher returns? Is my question to you.
Yeah, generally our psychology wise, people don't want to take any risk. When they invest money, they don't want to lose anything. That's a primary idea, because the money what you are making from the market, the happiness, uh, then the what you are losing in the market, the sadness is very worst. So people don't want to lose the money, but at the same time, when you are investing into the market, the idea of investment is to beat the inflation. To beat the inflation, you need to take certain level of the risk. The thumb rule is higher the risk, higher the return, lower the risk, lower the return. So if you want very safe return, of course, I agree, people don't want to lose the money in the investment, but at the same time, you need to meet the inflation at any cost. Even if you are keeping your money at your locker safely, your money value is eroding by day because of the inflation. To beat that, you need to take a certain level of risk according to your risk ability. You don't want to take a higher risk where your colleague or your peers are taking, but as per your age, your risk taking ability, take a risk to beat the inflation to earn a better return.
Some people, Ariel, obsess about their portfolio. They keep frequently checking their portfolio. Does checking increase the risk of making poor decisions? Constantly going back to it.
Oh, there is no point of checking portfolio on the regular basis. This is like you seed for something, and every day you are digging and seeing the seed. So that's not a right idea, right? So
Yeah.
you need to give some the valuable time to grow for the tree. So exactly similar to like in the portfolio, you build the portfolio based on some goal oriented, some risk ability, and you are all this considering all the points. So once you build the portfolio, give a proper time to grow. There is ups and down in any expert build the portfolio or any kind of the investment. There is ups and down. So need not to worry about that. Have a time frame, have a time horizon. If you are looking for the investment for 10 years time, need not to panic in between, because there is that ups and down is always happen. If there is a down, use the opportunity. If there's a up, enjoy the your profit in the portfolio. But looking on the everyday or regularly looking the portfolio will not help you. In other side, it will give more panic to you. So because of that, you may take any wrong decision. So have a passion and be stay with the investment.
Your money is not going to work hard by itself. It needs these talented independent financial advisors. Remember, Money on Duty with me, Hrishi K, is powered by SBI Mutual Fund, a partner for life. And these IFAs come in every single day over the next fortnight, Monday to Friday for 2 weeks, decoding money for you. That was Ezhil Murugan, founder director of Wealth Seva. Ariel, wonderful of you to talk to us, and hope to catch up with you soon. Thank you for your insights. Cheers.
Thank you, Rishi. Thank you very much. Bye.
One world, your station.